Hello, everyone. Are you ready for some financial fireworks? Because the Supreme Court is about to dive into two massive cases that could totally shake up your wallet, our economy, and even your government investments. We're talking about decisions that could either send our economy soaring or make us financially weak. So let's cut through the noise and get straight to the facts. What's really going on, and how could it impact your money? First up, a huge legal battle over President Trump's tariffs. Now, tariffs are basically taxes on imported goods, and they've been a hot topic. The U.S. Constitution gives Congress the power to set these taxes and regulate trade. But over the years, presidents, including Clinton, both Bushes, Obama, and Biden, have been given permission by Congress to impose tariffs under certain conditions. President Trump has also used these existing rules, especially for his significant fentanyl tariffs against Mexico, Canada, and China, and those global reciprocal tariffs he announced back in April. Here's the twist. A recent court decision said that while the tariffs themselves weren't necessarily illegal, President Trump used the wrong law to impose them. This specific emergency law, which is nearly 50 years old, has been used by presidents many times, but never before to slap tariffs on imports. It's usually for things like restricting financial dealings with specific countries or entities, not for widespread import taxes. So while the courts didn't get rid of the tariffs right away, they've left them in place for now, giving the administration until October 14th to appeal to the Supreme Court. If the Supreme Court doesn't side with the administration, President Trump still has options. He could try to use a different existing rule to impose the tariffs, or he could even ask Congress to pass a brand new law just for this. But let's be real. Convincing Congress is a whole other ballgame and a lot more work. These alternative paths would be cumbersome and require more work and effort from the administration. Now, why does this matter so much for you and the country? Well, President Trump and the Treasury Secretary have said these tariffs are a key way to bring in money for our country, helping to reduce our massive budget deficit. A nonpartisan group called the Committee for Responsible Federal Budget estimated that these recent tariffs could generate a staggering $4 trillion in total deficit reduction over the next 10 years, from 2025 through 2035. That's a huge chunk of change. While it won't balance the budget on its own, for anyone worried about our growing national debt, that extra $4 trillion in tariff money is definitely preferable to not having this extra revenue and needing to borrow even more through government debt issuance. This is a high-stakes game, and the Supreme Court's decision could really change how our country manages its finances and keeps paying its treasury holders. So, the big question is, will the Supreme Court rule in favor of the current approach, or will we see a scramble for new ways to keep these crucial revenues flowing? All right, let's pivot to the second major case heading to the Supreme Court, one that could totally change your interest rates, your mortgage, and the entire financial landscape. We're talking about the shocking firing of a Federal Reserve Governor, Lisa Cook, by President Trump. The rules for the Fed state that governors serve a long 14-year term, and they can only be fired for cause by the president. What does for cause mean? Basically, doing something seriously wrong while in office. No president before Trump has ever tried to fire a Fed governor this way, so this is uncharted territory. President Trump fired Lisa Cook last week, claiming she lied on her mortgage applications back in 2021. If you knowingly lie on a loan application to get a better rate, that could be considered mortgage fraud, which is a federal crime. The allegations are quite eyebrow-raising. Records appear to confirm that in June of 2021, Lisa Cook took out one mortgage for a property in Michigan, stating it would be her primary residence. Just 2 weeks later, she secured another mortgage for a condo in Atlanta, also claiming it as her primary residence. Obviously, you can't live in two places at once. Then there's a third mortgage for a condo in Cambridge, initially listed as a second home, but later declared as an investment rental property in government ethics filings from 2022 to 2025. Why would someone misclassify a property like this? Well, banks and credit unions, based on their experience, often assume that the closer a property is to your personal life, the more likely you are to make your payments. This is why loans for primary residences may be easier to get and may carry lower interest rates. Loans for second homes or investment properties are typically harder to get and come with higher interest rates because the bank thinks you might be less concerned if you default on those. Lisa Cook is fighting back, suing President Trump to be reinstated as a Fed governor. She argues that these allegations about private mortgage applications from before she was even confirmed to the Fed board shouldn't count as for cause to fire her. She believes the reasons for firing her should be directly related to her duties as a Fed governor. A federal judge heard her case recently, but it ended without an immediate ruling on Trump's firing. So, as we speak, it's unclear if she's still a voting member on the Fed's crucial interest rate decisions. This case is likely heading to the Supreme Court, forcing them to make a tough call about the ethics expected from our highest ranking officials, even in their private lives before taking office. This decision could have significant implications for our government investments and our money overall. But here's why this is huge for your money. If President Trump is able to appoint a new Fed governor to replace Lisa Cook, the chances of seeing faster and steeper rate cuts could go up substantially. Imagine that. This could dramatically impact your borrowing costs, from mortgages to car loans and even credit card rates. While no one can predict the exact impact on long-term bond yields, inflation, or the overall economy, what's clear is that the wild ride we've been on in the bond market isn't ending anytime soon. Keep a close eye on this one because it could mean real changes in your monthly payments and investment returns. Now, let's quickly check in on the bond market and see how your government investments performed this past week. When markets closed for Labor Day weekend, only the allegations about Lisa Cook were widely known. We'll have to wait until Tuesday to see the full reaction to that court ruling on the tariffs. But looking back at the past week, we saw some interesting moves. The very long-term government bonds, specifically the 20-year and 30-year maturities, saw their interest rates go up just a tiny bit by about 2 to 4 hundredths of a percentage point, respectively. But almost all other maturities continued to trend downward this week. The interest rate on the 2-year government bond fell the most, dropping by about 9 hundredths of a percentage point, followed by the 5-year, down about 8 hundredths of a percentage point. What does this all mean? Well, the difference between short-term and long-term interest rates seems to be growing again, at least at the far ends of the spectrum. The 30-year bond now pays about half a percentage point more than the 1-month bills. And this makes sense because the market is really betting on a rate cut at the next big Federal Reserve interest rate meeting. In fact, market predictions show there's now an over 86% chance of a quarter-point rate cut in September. That's up from the mid-70s last week. This would be the first rate cut since last December, if it happens. Even more, a Federal Reserve official, Christopher Waller, recently said he could even support a jumbo rate cut, a half-point cut, if the U.S. economy takes a sharp downturn. The August jobs report, which comes out this week, will be a huge influencing factor in that decision and where short-term rates go next. Looking at the year so far, from January 2nd until last Friday, all government bonds up to 10 years are down, meaning their interest rates have fallen and that yield curve continues to get steeper. The 20-year bonds rate is basically unchanged, but the 30-year bonds rate is actually up since the start of the year. If you're thinking about locking in current rates, those very long maturities, the 20-year and 30-year bonds, are showing a significant advantage. They're paying about 2/3 of a percentage point more than the 10-year bond, specifically 63 basis points and 69 basis points, respectively. That's a difference that really adds up if you hold those investments for the long haul. As for what's coming up in the world of government debt auctions, it's pretty quiet beyond the usual weekly short-term bill auctions. We'll see the 52-week T-bill auction this week, but no new longer-term notes or bonds are on the schedule right now. The expected interest rates for these short-term bills are available on financial platforms, but just remember, those numbers can and usually do change right up until the actual auction time. So if you're looking for short-term government debt, you've got those weekly options. In any event, with the Supreme Court potentially ruling on tariffs that impact our national budget and a high stakes battle over a Fed governor's job that could dramatically shift interest rates, we're definitely in for some exciting times. The bond market is showing us that big changes could be on the horizon. Don't be surprised by continued ups and downs. That's it for today, everyone. I hope you're healthy and well, and that you learned something new that helps you on your financial journey. If you found this information helpful, please give this video a big thumbs up. Don't forget to subscribe to the channel for more financial insights and hit that notification bell so you don't miss any of our brand new content. See you again very soon.